You snacked on a few flavors of stocks last week, but this week we have a few more flavors ready for you to try. If you like our content, please smash that like button and subscribe to the channel to help it reach more people that we can help with their investing. Let's get started. Snack on this, Flavors of Stocks Part 2. The first flavor of this week are dividend stocks and non-dividend stocks. There are plenty of ETFs that you will find that make dividend payments to the shareholders on an annual basis, on a semi-annual basis, or a quarterly basis. Basically, they're paying you either once, twice, or 4 times per year just to be in that stock. Dividends are exactly that. In their simplest form, they're just you getting paid to hold the stock. It's rather easy. It's pretty easy to understand. That's it. There's no catches, no gimmicks, no nothing else. Some stocks do require you to have a sort of holding period for that before you get the dividend. But other than that, you just have to have the stock in your portfolio, and the company that you have the stock in will typically pay you a dividend if they're a dividend paying stock. Now, they're doing this because a company is sharing a portion of its profits with you in the form of a dividend payment. This has a lot of accounting implications, does a lot of things for them on the tax side of things, but what you need to focus on is that you're getting free money just to hold that stock, even as the value of the stock appreciates. These stocks are great additions to your portfolio because they provide an income for investors, right? So the stock price is appreciating, that's great. But the dividend is what brings that income into that equation. So you're earning more from the stock because it pays you dividends. A few tickers of the highest paying stocks are the following: NHI, MO, UVV, CM, BNS, and BMO. Keep in mind that this is the amount paid per period when you look at their dividend yield. But these companies should get you started in the right direction when you're trying to figure out what stocks pay better dividend yields over the long term. These stocks are great examples for you to take a look at, but use your own judgment when you start entering in those trades and buying stocks that pay you dividends. Non-dividend stocks, pretty much self-defined. They don't pay dividends to the shareholders. Now, this doesn't mean that they're bad stocks to hold just because they don't pay dividends. Some of the biggest companies in the world don't pay dividends. You're looking at Tesla, Facebook, and Amazon. Some of the largest companies with tremendous revenues, they're not paying dividends. Does that make them bad companies to own? No. You're gaining from the stock appreciation from those companies. Perfect mix of your portfolio would have both. A little bit of stocks that pay dividends and stocks that don't pay dividends. That way you get a little bit of that dividend income, but you get some of that greater appreciation that you tend to see in some of the tech companies that don't pay dividends. The next flavors of stocks are cyclical and non-cyclical. And I'm definitely going to mess the pronunciation during the course of this portion of the lesson. Economies tend to follow cycles of expansion or prosperity or contraction, aka recessions. It's common and it happens all the time. Certain businesses have exposures to these cycles or are better prepared for these cycles, which we'll call cyclical stocks. Some of the best cases for cyclical stocks fall under the following industries: manufacturing, travel, and luxury goods. When the economy is booming, these stocks do amazing because we're seeing periods of prosperity. Where they get hit the hardest is those periods of recession where people don't have that much free cash flow to travel, to buy luxury goods, and manufacturing gets cut off. And that's why you see a lot of job layoffs when that happens, especially in the manufacturing sector. As I mentioned, economic downturns affect these industries heavily. Take a look at the world around you right now. You don't see too many people going around buying $1,500 shoes or $800 t-shirts. Luxury goods are suffering as a result of COVID-19. That is at its purest form, cyclical. When the economy gets better again, and it is a matter of time before it does recover, these sectors will continue to boom, will get much stronger until the next downturn. Non-cyclical stocks don't follow this pattern. Non-cyclical stocks are typically companies that you can get into that don't really follow the ebbs and flows of whether the market is doing well or whether the market is doing weakly. Examples of this are grocery stores or essentials stores. Think of your typical convenience store or a typical corner market, anything like that, where it doesn't really matter if the economy is doing well or not. People are still going to go out to buy items within those industries because they need them. You always are going to need food. You're always going to need bread. You're always going to need essential items. And those companies that are in these specific sectors tend to do well throughout the year and don't really get affected based on the seasons, based on the cycle, based on anything else. Their fates are their own. And they don't typically follow any sort of ebbs and flows that might occur as a greater result of what's going on. Non-cyclical stocks are typically great during downturns, but you don't see the appreciation of those stocks that you do from the cyclical stocks during bullish times. Now, there are a lot of sectors that we didn't mention in our lesson, and we did that on purpose. We want to highlight some of the more basic examples for you to understand, and we will have more in-depth lessons in breaking these flavors down for you further. Spoiler alert. Alright, now for the most fun flavor of the bunch, or the fun flavors I should mention. You may have heard of the term blue chip stocks and penny stocks, right? Well, invested appropriately, you could actually get some pretty good returns in having both in your portfolio. Majority blue chip, but penny stocks are fun too. Let me get into this in a second. Blue chip stocks are the creme de la creme in business. Strong companies with strong reputations that are huge leaders in their respective industries. They don't have the highest returns that they can, typically, but they are stable. And they aren't as prone to risk as the following flavor. The good old penny stock. Get rich or lose your money trying. Penny stocks are very, very often low quality companies that are speculation based only. So it's kind of like gambling for the most part. They have very speculative business models. They have very risky balance sheets, and they tend to be pretty inexpensive, which is why they're called penny stocks. As such, people don't typically invest into penny stocks as sort of the traditional investment. They mainly use them more to gamble with or to hit those home runs. Penny stocks allow you to purchase a huge amount of shares in one go for the prospect of amazing returns. Now, we don't want to throw shade at any of the penny stock traders out there, but we want to warn you of the risks in trading penny stocks. These types of investments are very risky, especially since a majority of the folks that are trying to get into penny stocks or trading penny stocks are looking to strike gold within them. Will it hurt you to throw a couple of $100 into a penny stock that costs maybe 20 cents a share to get you 1,000 shares? No, it probably won't. But you'd probably see that $200 leave rather than appreciate and become something humongous. That's typically what happens in the penny stock world, unless the stock is being manipulated to some fashion by a bunch of outside parties, which are typically out of your control. You can keep your risk low by having a few of these gambles here and there, but keeping your exposure very minimal in your portfolio to these types of stocks. Remember, think long term when it comes to your portfolio, but a tiny bit of fun never hurt anyone. I've personally had wild rides with penny stocks. They're amazing to learn lessons from, especially when you try to connect the overarching market activity to those particular stocks. I've had times where I've seen money come so quickly that it would make my head spin. But on the flip side, I've also lost money so fast that it would make a Bugatti look like a horse buggy without the horse. The point is, proceed with caution when you get into penny stocks, and don't keep an overwhelming majority or tons of your portfolio into these type of speculative investments unless you can stomach that gambling type of activity. If that's what you're into, go for it. But again, for a healthy long-term portfolio, we'd recommend penny stock trading here and there just to sort of learn a little more about the trading environment without having too much outlay or too much investment in the beginning. Both lessons, part 1 is in the description below, are flavors that you can use to spice up and spruce up your portfolio for the long term. It creates a well-balanced and healthy portfolio for you. It's a lot of information, right? But it's key as you build out the mechanics of your portfolio for that long-term investment. Comment down below and let us know if these lessons are helpful for you, or if you have any flavors that you can think of that we may not have mentioned that are beneficial for a portfolio to have. Until next week, taste a few flavors, gather some names, and keep investing.